Ladies and gentlemen, good afternoon. My name is Simon. I'm your MC today. I'm the Senior Manager of International Business Development at Invest Hong Kong. A warm welcome to all guests and participants both online and on-site here in Hong Kong. Today, we are very delighted to co-organize the ELIFT Forum 2023 with Asia Treasury community. Also, a huge thank you to our supporting organizations, Federated, Hermes, and Hong Kong Financial Service Development Council, for your joint effort to make this event happen. We are honored to have elite leaders in finance and treasury sectors gathered together to share their first-hand experience and insights on money market funds, the latest development of cross-border payments, and the power of fintech in the digital universe. In the end, there will be a forum discussion and Q&A sessions where participants, both on-site and online, are welcome to ask questions. We have a fruitful event ahead of us, so please allow me to introduce our very important speakers for today's forum. Mr. Stephen Phillips, Director General of Invest Hong Kong, of Investment Promotions of Invest Hong Kong. Ms. Paige WILHELM, Senior Vice President, Senior Portfolio Manager, Head of Prime Liquidity Group of Federated Hermes from the United States. Mr. King Leung, Head of Fintech of Invest Hong Kong, and Ms. Rakhi ASWAL, CFO of Saxo Group from India, who is joining us online from India today. Last but not least, our moderator for the forum discussions and Q&A sessions, Mr. Albert Yip, Chairman of Syndicate Capital Group. Thank you all for your presence. Without further ado, please allow me to invite Mr. Stephen Phillips, Director General of Investment Promotion at Invest Hong Kong, to deliver the opening remarks.
Well, Simon, thank you very much. And ladies and gentlemen, good afternoon, and a very warm welcome to Invest Hong Kong. It's great to see you here. And to those of you online, good afternoon as well. We're really delighted to have so many of you here as elite leaders in finance and treasury, and a particularly warm welcome for those of you who are visiting from outside Hong Kong. I'd particularly like to thank Lynn and the Asia Treasury community for working with us on this, something that has been in the genesis for a very long time, and COVID had an impact on many plans, including this. I'd also like to thank our partners, Federated, Hermes, and the FSDC. Obviously, we're here to talk about a whole host of different subjects related to financial services, corporate treasury centers, some exciting developments in fintech. It relates to Hong Kong's role as well as an import-export hub, which obviously drives much of the flow of money into and out of Hong Kong. And Hong Kong's role too as a route both into and out of the mainland in terms of major capital flows, where we see investments from around the world, both into financial investments and into operating businesses, moving in both directions. So I think there's a lot to talk about. And I'm sure we're going to have some very rich discussions during the afternoon. Clearly, the world is going through quite a challenging period geopolitically. If we look at the economic landscape, there are challenges, high inflation, increasing interest rates. And of course, this all creates uncertainty for businesses around the world. And of course, CTCs have a role to play in this in terms of risk management, increasing the visibility for CFOs of what's going on within the business. And we think Hong Kong is a very fine location for a whole range of different businesses, to have CTCs. And certainly over the years, Hong Kong has been at the forefront of some of the developments taking place in the CTC space. But I think we're going to see a lot more change ahead, and maybe King will touch on some of the stuff that he's seeing from the fintech side that will be adding fuel to that transformation. And of course, transformation goes hand in hand with digitalization. And across the entire economy in Hong Kong, we're seeing this rapid transformation. It's not unique to Hong Kong. It's something happening all around the world. And it's been accelerated by COVID, no doubt. On the fintech side, we've now got over 800 fintechs in Hong Kong in every conceivable vertical that you can think of. The government and the regulators are also providing lots of support to the further development of fintech. So I think we'll see some exciting developments. Hong Kong last year set out its position around virtual assets, where we are probably leading the way in many ways as an international financial centre on that front. The Hong Kong Monetary Authority is doing a lot of exciting work around e-Hong Kong dollar and working with mainland authorities around ECNY. And of course, that then leads on to Hong Kong's role as the international hub for the renminbi. And that has very profound implications, I think, actually, if we're looking at CTCs and the corporate world going forward. This trend towards de-dollarization, increasing use of the RMB for settlement. We're seeing many of those discussions going on, China, Brazil, China, Saudi. So there's a shifting sands, shifting landscape taking place, but probably nowhere better in the world is suited to adapting to this changing landscape than Hong Kong, given its position under one country, two systems, part of China, but very much the international financial center of both the country and one of the top three internationally. Lots of exciting stuff too happening between the capital markets of Hong Kong and the mainland, again driving different flows of money, both north and southbound, all of the Connect schemes, which I'm sure you're all aware about. Those will continue, I think, to emerge and develop. I think there was some indication yesterday that Wealth Management Connect, which is one of the newer ones, is being revised, or we're looking at revising the regulations for that. At Invest Hong Kong, our role is to help international and mainland companies to both set up and grow here in Hong Kong. So we work with companies of every shape and size, from large multinationals all the way through to early stage companies. And not surprisingly, a very large portion of our clients come from the financial services space, but there's a very big chunk of corporate clients, particularly out of the mainland, that set up CTCs here. So if we can ever help any of you or any of your clients or your partners to set up in Hong Kong, or if already here, to help them find growth avenues, that's our job. And we're always happy to have a chat. Outside Hong Kong, we've got teams all over the world in 34 locations. So there's somebody quite close by in the same time zone to have a chat to businesses all across the world. So I think I've said enough. We've got far more interesting speakers than me coming up. So I'll once again say thank you very much for joining us. Do enjoy the afternoon, and we look forward to some stimulating debate. Thanks for joining us.
I just wanted to start, thank you for having me today. And I wanted to start by giving you a little bit of background about Federated Hermes. It's not Hermes, unfortunately. I didn't come with scarves and ties. I wish I did, but I did not. I'm a portfolio manager at the company, and Federated, for those of you that aren't familiar with Federated Hermes, we have operations around the globe. We're probably one of the biggest asset managers you never heard of. We manage about 700 billion in assets with offices around the world. And this chart just depicts some of the asset classes that we manage. I'm in charge of our prime money market funds. If you look at the top left-hand box there, we run about 500 billion in cash products. So these are portfolios that are buying securities 1 year and less, so overnight out to a year. I'm responsible for the prime portfolios. Those are the ones that take credit risk. We buy things like commercial paper and bank CDs. Federated also has government-only money market funds. And once again, I'm talking about US dollar here. Our government funds invest exclusively in US Treasury securities and US agency securities. In addition, we have tax-exempt portfolios, but those are only tax-exempt in the United States. We then have a fixed income team. They manage our mutual funds that invest greater than a year, up to 30 years. And we have equity products and alternative private market products. So that's just a little bit of background about Federated and who we are. My goal today is to talk to you about your cash needs and where you might want to invest your cash to get the best returns, whether that's short-term or maybe a little bit farther out the curve. When we look at the United States and we look at the Fed and we think about what they are doing with interest rates, the Fed has a dual mandate. They're looking at inflation and the employment situation. And I'm sure you're all aware that the inflation situation is very high all across the globe, but especially in the United States. And our inflation numbers are still running very high. The Fed's goal is 2% inflation. We just had CPI released yesterday, I think it was 4.9%. So inflation numbers are much higher than the Fed is looking for. Thus, they've been raising rates pretty dramatically. They increased interest rates by 500 basis points in the past, call it year and a half or so. And we're expecting that they might continue to raise rates at their next meeting, which is in June. So the Fed's dual mandate is not only the inflation outlook, but also the employment situation. And just like around the globe, the employment situation in the US is more demand for workers than supply. So our unemployment rate is very low from a historic standpoint. It's about 3.5%. So the Fed does not feel like they're done yet. And at the last Fed meeting, Chairman Powell actually expressed that inflation, bringing it down to 2% is still their goal. Now, other things have happened in the past couple of months. Most recently, in the middle of March, we had the Silicon Valley Bank crisis, and that kind of sucked in some other regional banks in the United States. This chart is just showing the very short-term interest rates. If you say the purple line is the 1-year T-bill, and the green line there is the, the green line there is the 3-month T-bill, and the 1-year line is the 1-year bill. Should have brought my glasses up here. But obviously, when Silicon Valley Bank failed, we had a huge flight to quality. People were buying treasuries. People were afraid of the regional banks. It started to spill over into some of the other banks, and you saw this huge volatility in the U.S. short-term markets and even the long-term markets for those couple weeks in the middle of March through the end of the month. Had you gone on vacation during those 2 months or 2 weeks, you might have not even realized what happened when you came back if you just looked at the yield curve. But a lot of volatility then during that time period. We follow a lot of banks for our money market fund investments. We have credit analysts that follow the banks for us. Because we're money market funds and most of our funds are rated AAA by the rating agencies, we're only investing in very, very high quality banks, whether they're domestic in the United States or global around the world. We did not have exposure to the regional banks. Silicon Valley Bank, as well as the other 2 banks that failed, Silvergate and Signature, didn't issue short-term instruments. So you wouldn't have found any money market fund that had exposure to any of those names. They didn't issue commercial papers or CDs, but other regional banks in the United States did. And during this time, the other regional banks were also getting pulled into the problems that Silicon Valley Bank had. When we look at the market during those 2 weeks and concerns about how short-term securities were trading, we really didn't see many problems in the market. Things didn't seize. We could still buy and sell commercial paper and bank CDs. What we did see happen was Silicon Valley Bank failed on March 13th. And the next week, you saw issuers come to market with paper that they were just issuing out overnight out to 1 week. So they were keeping their funding very, very short. They weren't issuing out longer, 3 months, 6 months, 9 months. But the other thing that was going on was the Fed meeting. The next Fed meeting was March 22nd. And in this rapidly rising rate environment that we've been seeing, typically investors, when you got very close to the Fed meeting, were just buying money overnight out to 1 week or to that next Fed meeting date, because obviously you wanted your securities to mature so you could capture that next rate move from the Fed. So it wasn't necessarily unusual that the week before the Fed meeting, issuance from the issuers was very, very short. It was exacerbated because of Silicon Valley, but it still wasn't all that unusual. And then in addition, March 31st is quarter end, and that's typically one of the most volatile quarter end of the year for money market products. So all of those things were happening at the same time, but we didn't see the markets have any issues. You could buy securities, you could sell securities in the money market space. So it was just, I think, a little bit of confidence that the banking issues that were happening were isolated. They were idiosyncratic events, and they weren't systemic in nature, and they weren't spilling over into the larger banking sector in the US. Now, if you follow, you're a nerd like me, I don't know if that word translates or not. If you follow the Fed funds futures contracts, if you look at this chart, the green bars were the expectations for where Fed funds were going to be, or what the Fed was going to do with the short-term rates at the end of February. So at the end of February, the market was still expecting that the Fed was going to raise rates in May, in June, in July, and then keep rates on hold for a period of time because inflation was still running rampant in the US, and the Fed wanted to get that under control. Now you have the Silicon Valley events that happened in the middle of March. And if you look at the blue bars, suddenly the Fed funds futures contracts are pricing in cuts from the Fed because they're afraid that what is happening in the banking system is systemic. The Fed may have gone too far in raising rates, and now they're pricing in rate cuts immediately into the summer and through the end of 2023. At Federated, our outlook for short-term interest rates in the US is that the Fed will potentially raise rates again at the June meeting by 25 basis points, but they could be very close to the end of the cycle. They might not raise rates in June, but we don't believe that they're going to cut rates this year. They're going to watch and see how their monetary policy is impacting the economy. Typically, when the Fed raises rates, that's about a 1-year lag on its impact to the economy. So not only are they looking at inflation and employment and the 500 basis points that have already been raised in the United States and how that might impact things going forward, but because of the Silicon Valley crisis, now the impact to credit lending is probably going to be a little bit stronger than it was just because of interest rate increases. So we'll be monitoring what's happening with lending standards and with credit across the banking system. But if you listen to Chairman Powell during his press conferences, he doesn't want to put a number on what credit tightening can do to interest rates, but he's alluded to the fact that credit tightening in the banks could act like a 25 basis point rate increase for the Fed or something higher. So they don't want to go too far, but we think what they're going to do is either another 25 in June or stay on hold throughout the rest of the year before they would cut. We don't believe in cuts this year because they still have to get inflation under control. So in that rate environment, if you are in the same boat as we are, and you believe that the Fed is getting close to the end of the hiking cycle and is going to stay on hold for a period of time, this is a chart that I like to look at that shows the effective Fed funds rate, which is the blue line, versus the bank deposit rate in the US. And this chart goes back to 2003. But if I went back farther, back to the 80s, this pattern would look the same. As the Fed raises rates, the banks are very, very slow to raise rates. But on the day the Fed cuts rates, they're going to cut their bank deposit rates very quickly. So historically, over time, you don't see bank deposit levels keeping up with the Fed funds rate. Now, money market funds, if I were to superimpose another line onto this chart, because money market funds are buying short-term securities in the direct market, their yields are keeping up with that Fed funds rate, and they would track that progress. The other thing about money market funds is that they typically lag when the Fed is on hold or when the Fed is cutting rates. So if you believe the Fed's on hold or potentially going to start to cut rates at some point, the money market funds yield will lag. And that's because we'll have an average maturity somewhere around the 40 to 50-day range. Sorry, I'm getting the signal to quit. Another thing that I wanted to bring up with you is at Federated, we have something called the Short-Term Investment Committee. And this committee was started back in 2020, and we get together on a monthly basis. It's the money market portfolio managers, as well as our bond portfolio managers that invest. The bond managers invest out to about 3 to 5 years. We meet on a monthly basis to just talk about where's their relative value in the market today on the fixed income space based on our outlook for the Fed. And throughout the past couple of years, we have these 3 buckets at the bottom: money market fund investments, bond fund investments in the ultra short space. So that would be a duration of about 6 months to a year, and low duration products, which would be about 1 year to 3 years. And each month we discuss where do we think there's value. And as you can imagine, the money market funds have been #1 throughout the past 2 years, just because of the rapidly rising rate environment. It was best to have your money there. It was going to reset quickly. Just in the past month, though, we have switched our #1 outlook for relative value to be those ultra short funds. So if you think the Fed's getting close to the end of their hiking cycle, from a total return standpoint and a relative value standpoint, the ultra short space, as well as the money market funds, could be a good place to have your cash in the upcoming cycle. I think I will end there and turn it over to our speaker.
Before I go into my sort of techy speech, I just want to express my respect to the work that Paige and your colleagues are doing. A little bit of a short story before I start. My wife, she used to be in the sort of Treasury capital management function with AIA more than 10 years ago. At the time, I was doing my own startup. So one evening, I was working on my laptop, looking at the financials, my company, thinking about fundraising and all that. So my wife just walked by behind me, and she peeked at my screen. She looked at the numbers. She's like, "Oh, wow, I didn't know that that's the kind of numbers you guys are working on in terms of magnitude. That's like a petty cash for AIA in Thailand." And then she was like, "Wow, look at it." And of course, she did not disclose the details of AIA, but then just the enormous amount of money that I think as an individual, before that conversation, I didn't have as much appreciation of the work that I think the Treasury folks are doing, because they're moving a lot of money. At first I was like, oh, just park at the bank. Actually, it's much more sophisticated than that. So I think I have a lot to learn from you after this event. Now, so perhaps when we look at the contribution that Fintech has to this sort of like Treasury topic, actually, besides looking at the more sexy stuff, like digital assets, the stable coins, I'd like to step back a moment to look at the basics, and that is about moving money around. Now, I think in the job of Invest Hong Kong, we have the privilege, we have the privilege of working with a lot of people internationally, like including companies and the major markets like the Peru, Chile, the Mexico. Now, the reason why I named these countries is because we had numerous conversations in the past 6 to 12 months, in which many of these countries are like, well, look, we are now doing so much business with China. In fact, China has been the #1 or #2 largest trading partner for many of these emerging markets, commodities and agricultural products and so on. And they have to really move money around. But then the speed, high cost is something that really get the management and the finance function that's very, very bothersome for them. So with that, I just want to highlight some of the highlights in terms of developments of payments in Hong Kong, particularly those related to B2B. Now, again, we've been trying to extract some news. Oops. Okay, so the first one I just want to quickly highlight is that for payments in the Hong Kong space, we have the privilege to attract a major unicorn to move the headquarters from Australia to Hong Kong. And a couple of years ago, it's a firm called Airwallex. It's founded by 4 very energetic young founders with a Chinese origin. And they've decided to park and really using Hong Kong as the headquarters. And then there's a conversation I had with the founder when they first moved over. I was like, well, of all places, why did you decide to park now in headquarters? You're coming in Hong Kong. And that's because of the cross-border trade. There's so many companies in China selling internationally, via like e-commerce or traditional exports. But then because of the currency conversion issue in China, they have to use Hong Kong as the kind of money exchange for them. And then they like to use Hong Kong as that bridge. Now, naturally for Airwallex, when they headquarter in Hong Kong, they don't want to just do cross-border. They like to do something, leveraging on the capabilities in the local market too. So they have essentially launched a whole host of B2B payment solutions targeting the SMEs. They're like, why not? Because we got these capabilities. And in fact, I think the numbers that highlight that just represented their growth, the enormous staggering growth within the past 1-2 years. And one of the reasons is because they're able to really think about payments in a different way, in which they are really extending out to talk to many vendors. They are providing services and products to the SMEs. And then the SMEs is like, okay, maybe we need accounting software, we need courier services from the FedEx alike. So they're really thinking through the user experiences of the SMEs to say, okay, maybe we can form this little consortium so that they're able to essentially negotiate some bulk discounts for their B2B clients, applying to SMEs and also moving up the value chain to larger corporations. Now, another thing I just want to bring to attention is that, particularly for Hong Kong, there's so much cross-border trade happening. And there are a number of players, and we just decided to pick a few as talking points. Now, obviously, the mainland Chinese players, they would love to do that in Hong Kong and then grow internationally. So you see names like Ping Pong, the ePay, the Nian of the world. And these guys are really transacting in the billions. I mean, in terms of transaction volume, they're huge. But they're just getting started to go international, particularly in places like Latin America. Now, on the other hand, there are also the international players. They also found it very attractive to have their presence in Hong Kong. So for example, for eBury, because I just came back from a business trip in London, so I met with the management team of eBury. They've done a fabulous job for cross-border payment. It's not just the payment. They also have done a fabulous job on the FX side to really provide a very attractive FX spread for their corporate clients. So the thing is that what you can take away from this is because of the Hong Kong unique nature of who we are and the trading partners coming through, we're able to attract some of the most competitive, the leading payment players, so that you're able to get some very attractive rates working with these partners. Now, another thing that is very high up on the list of a lot of corporates, in which they're like, okay, traditionally we are using the banks to help us move money across borders. But then, well, actually the banks, they seem like they're under attack from a competitive pressure from fintechs. then naturally we reach out to our banking partners, all the major banks that do cross-border trade. We're like, okay, what do you do to try to fend off the competition? And we picked out a few trends, but in the interest of time, I would like to highlight two examples. Now, the first is there's a virtual bank in Hong Kong. Essentially, the regulator of Hong Kong, they've launched 8 virtual banking licenses about 3 years ago. So the 8 of them, they all try to have their own niche. So one of them, in fact, the biggest one is called ZA Bank. Now, they've been going like almost like the full stack, from lending to financial products to insurance. And now they also are able to offer cross-border payments. Now, I talked to the CEO a number of times in the past few years. At first, now, by the way, ZA Bank, for those of you who don't know them, they actually have the origin from China, from Zhongnan, which is one of the largest, in fact, the first licensed virtual insurer with a very strong technology background. They thought, well, since we have all these engineers in China, why don't we build this ourselves? And then I think the more research they've done, they realized that, well, you know what? The cross-border payment is a much more complex business than they realized, than a bunch of engineers building out a system. So then they have done their own homework and they realize that probably it's better off for them to partner with the existing solution, an existing player, white label. So then they reach out to Wise. They used to be called TransferWise in UK. So now TransferWise also pivoted. So now they're offering their capability as a payment platform, white label. So great. So then the ZA Bank just used the white label Wise engine to enable their B2B, their corporate clients to move money around internationally. So this is a great way to catch up while remaining competitive. Now, another firm that is called Alpha Fintech, I think many of you may not have heard of them, but I think it's an amazing company. So the founder of the company is from Australia, and he decided to really do it in such a way that to gain enough traction before he raised money from outside. And next thing you know, he already sunk in, I think something like $25 million US of his own money to build up this company. So I think he should have very deep pockets in order to afford to do that. Nonetheless, this is an amazing company that have really looked at how a bank can revolutionize the way that they do payments in a way, arguably, with the same kind of competitiveness as the fintechs. So for them, they actually is going around selling solutions to the banks. Okay, you don't want to be out-muscled by the more nimble, tech-savvy payment fintechs, you should adopt this platform. And guess what? Well, actually, he just exited last year because there's just so much demand right now. The banks realize if they don't transform themselves, they probably will have the lunch eaten by the faster, more nimble fintechs. Now, another example that's actually very much on the headlines are stablecoins. Because of course, last year, for those of you who follow the news, stablecoins are no longer stable, right? You look at the Luna and even see, the USDC, USDT, or just wow, look at the whipsaw of the charts. So that's why a lot of people are like, well, gosh, this is a very sort of like unsafe kind of unsafe, but they still call it stable coins. So how do we crack this problem? Well, perhaps getting a proper guardian, a proper regulator. To regulate them is a good place to start. So that's why when our regulator, the banking regulator, HKMA, and our de facto central bank, they look at this, they appreciate the value that stable coins can have to the economy, particularly as we transition to digital economy. There's a place for stable coins. At the same time, given what we learned from last year, this crazy volatility, perhaps we need some proper guardrails. So they've launched several consultation papers, so that they now really learn from the market. And HKMA is now scheduled to launch the stablecoins regulation, well, I would say within the next year. So ideally, we're looking at perhaps Q1 of next year that they will launch the regulation. Now, and why is this important? Because outside of Hong Kong, in several other jurisdictions, I was in Canada, so I talked to a Canadian stablecoin issuer. I was in Tokyo, I talked to like Japanese yen stablecoin issuer. So there are a number of really, I would say, forward-thinking entrepreneurs. They saw that. And now they already got the business up and running. But because the transaction volume is just so small, they're like, okay, we need to be in a place where there's a much larger transaction volume. So that's why they're now eyeing on Hong Kong as a place to move the business over, to get a license for HMA, and then they can do cross-border payments using stablecoins. Now, in the interest of time, I won't go into the details. Just perhaps 2 more slides to wrap up the sharing. First, you may have heard of the CBDC, right? Central Bank Digital Currency. Interestingly, back in, I think it was 2022, PwC has launched this survey and a study, essentially looking at the market readiness of CBDC by jurisdiction. And interestingly, to our pleasant surprise, Hong Kong and Thailand were rated co-1 in the world when it comes to wholesale CBDC market readiness. And as I talked to our colleagues at HMA, technically they're ready. They're just waiting for the right timing to really launch it to the market. And then I think there's this Enbridge, I won't go into details, it's another project that HMA has used to really test out these like multi-jurisdictions usage of CBDC. That involves, of course, China, with the People's Bank of China, the Central Bank of UAE, and now also Bank of Thailand. So this is also happening. I think I'll skip that. So this is my contact information. Again, I hope that the information, again, I know there's a lot of information that overwhelm you, but hopefully you can take away with something that's useful. So thank you so much for your attention. Okay, I'll pass it on to the MC for the next speaker. Thank you very much.
Thank you so much for giving me this opportunity to speak about this very important topic of power of fintech collaboration in the digital universe. I think a very relevant and very contemporary topic in today's world. It is no secret that India has emerged as the hub of digital revolution in the financial landscape. Indian fintech market, which is the third largest in the world, is estimated to reach US $1.3 trillion by 2025, growing at a CAGR of 31%. And a large share of success of Indian fintech market goes to the Indian payments landscape, which has completely transformed over the last decade, catalyzed by a shift from cash, cards, and other traditional payment methods to real-time account-to-account payments, which is powered by UPI network and mobile apps. I'm going to talk a little more about UPI later. UPI is Unified Payments Interface. But if we talk about the retail payments in India, about 63% of the retail payments in 2022 was through UPI network. That's the real-time account-to-account payments, when compared to just about 9% through cards. Prior to UPI, Indian fintechs were already driving the market towards mobile payments. And this push started sometime in 2014. With the introduction of digital wallets, we all must have heard of Paytm digital wallet or Google digital wallets, Apple wallets. These mobile wallets were propelled by India's demonetization policy, which happened sometime in 2016. So this was a large-scale macroeconomic exercise which was implemented by the government of India to combat corruption and also to push digital payments. So the government of India in 2016 discontinued the acceptance of all existing currency notes overnight. And this led to shortage of cash circulation in the system. And this was the perfect opportunity for fintechs to come up with some digital solutions for the consumers, for the merchants. The UPI payment, the account-to-account real-time settlement, was launched in 2016 in India, and this was launched by National Payments Corporation of India, which was established by the Central Bank of India called Reserve Bank of India, RBI, in 2016. This is account-to-account payment system that enables consumers and merchants to send and receive payments with real-time settlement. Like I said, almost two-thirds of the retail payments today are powered by UPI in India. UPI is not an end-user product, it's a payment network, which is used by fintechs and banks who develop and distribute these mobile apps that power payments through UPI network. Users can very easily enable this payment method on their mobile who have bank account and have a mobile number. That's all is needed to sign up for these UPI payments. India is now the global market leader for real-time A2A payments, but certainly certainly not the only country. There are a lot of other countries who are seeing a lot of uptake in the real-time A2A payments. Brazil comes right behind India when it comes to that. So if we talk about the number of transactions of these real-time payments, India is definitely the country which has the highest number of real-time payments, which stands at about 74 billion. Right behind India is Brazil, and this is from last year, from 2022. Uh, right behind India is Brazil, which stands at 24 billion transactions in 2022. China was at 21 billion real-time payments transactions in 2022. So countries around the world are drawn to the UPI story of India, and they also aspire for efficient digital payments alongside financial inclusion. The National Payments Corporation of India is working to internationalize UPI, has also signed MOU, Memorandum of Understanding, with 13 countries. India is also working with payment providers like WILHELM in Europe to implement Indian payment methods, including RuPay and UPI in countries including Netherlands, Belgium, and Switzerland. I think India is a perfect example of the power of fintech to transform economy and also touching the day-to-day lives of people in the country. Within less than a decade, India has gone from a widespread lack of financial inclusion to a country that is now leading the world in A2A real-time payments. And the reason for such growth is the fast growing digital adoption on the because of the increased use of smartphones, because of availability of low cost data, but also uh, one of the major reason is because of the structural changes that we have seen, the structural reforms by the government that we have seen in the recent past. World-leading digital infrastructure, which is coupled by the enabling regulatory environment in India. And with this increase, with this adoption of fintech and this success of fintech, what really becomes very important is the collaboration between fintechs and other players within the financial ecosystem. I think there is definitely a clear need for a collaboration between banks and fintechs to create a win-win model, because fintechs and traditional banks, both of them have very unique and very complementary strengths. I think the traditional banks, they come with a very huge customer base, with reputation, and the fintechs, they come with technology, they come with innovation. In India, we are seeing, just like King gave a lot of examples of collaboration of fintechs with other players. Similarly, in India, we are seeing cases where traditional banks are partnering with fintechs to provide very customized, very different new age products to the customers. We are seeing collaboration when it comes to technologies, where it can be where fintech can provide technology for point of sale, uh, uh, at point of sales usage. Also for the payment gateways where fintech can provide better technologies, we are seeing that banks are collaborating a lot more with the fintechs there. But when we talk about this kind of collaboration to become successful, what is really important is that these connections or these collaborations focus a lot on agility and on able to scale up very quickly when it is required for the banks. Also, what would become very important is that traditional banks come with an innovative mindset, a mindset uh, to experiment, to accept newer technologies, to take that kind of risk. And thirdly, what becomes very important, and I think would also be kind of foundation for this kind of collaboration, would be cultural compatibility and respect for each other. Without cultural compatibility, I think any kind of integration, any kind of collaboration can fall flat on its face. So these are few things which becomes very important for bank and fintech collaboration. I would like to conclude by saying that fintech has transformative power. It has the power to change the day-to-day lives of the people. And what would be the real strength of the fintechs then would be its ability to collaborate with the other key players in the financial ecosystem. With that, I would like to end my presentation. Thank you.
I'm by no means expert on the CTC, but then I can share from a different angle. Because naturally, the past few years have not been usual by any historical standard. And the more people I talk to, particularly now that the border is open, which I have the privilege to travel to the US, to Canada, to Japan. I just came back from London. And one thing that I constantly ask the folks internationally about where they want to do business. And to be honest, that answer changed compared with several years ago. So naturally, again, I was educated and I worked in the US for many years. In fact, 13 to be exact. So I love the environments. But at the same time, something is changing too. Now, particularly in the space of fintech, which I spend more time in. Now, I think for a lot of folks in this space, yes, of course, the market size is important. Then there's one thing even more important, and that is how open-minded the policy makers are, and also how open-minded the regulators are towards the innovation, right? How things will be changing in the future. Now, so naturally, again, in the sort of digital asset space, which Albert alluded to, a lot of things have changed. Now, of course, I think if you look at the underlying, this is really about changing the way that commerce or finance worked with some new technologies, maybe DeFi, we'll talk about blockchain. It's just a different way of doing things. But then because that is the way have some unfortunate incidents last year that I think gave the regulators, for example, SEC, some pause. So now Mr. Gary Gensler, I think the last time I read, he was asking the Congress for a budget of $2.4 billion of extra budget to hire more people to supposedly catch the bad guys. So that really scared off a lot of really smart people. When I was in the US in early March, they're like, wow, okay, we're just building technology. But then now we are really scared. So as a result, a lot of these smart people who are in a way helping to create, I think, the future backbone of finance infrastructure. They're looking for a place where the policy makers and the regulators are a bit more, again, not my words, their words, are more reasonable. So then they go around the world and again, I don't want to name names. These are like household tech firms and so on. They've been literally starting from I think last year. They began this worldwide tour. So they would go to, I think, London, they would go to Dubai, to Abu Dhabi, of course, Singapore, Hong Kong, in a way, decide to try to find a safe home, okay? Which is kind of something that is unheard of. I can't even imagine you had this conversation, say 3-4 years ago. Now, so the reason why I bring this up is because, yes, the market sizing, yeah, it's important, right? The infrastructure in terms of traditional finance, yes, important, but things are changing. So how open-minded the government is and regulators and how reasonable they are in drafting the rules is also something that's important in attracting the smart people. And once the smart people are in a market, then good things tend to happen. Again, this is a big question, a big topic, but maybe I'll just stop here.
I think the U.S. banking system is strong and sound and resilient. The events that happened with Silicon Valley Bank and some of those smaller regional banks were really isolated to those banks themselves. From a credit standpoint, they were just complete asset liability mismanagement. It's similar to the savings and loan crisis in 2000 or in the 1980s and 90s, or the problems that we saw with structured investment vehicles in 2007. You have to have an asset liability match. So I think the U.S. Banking system is strong. Yes, lending standards might get cut back a little bit, but the big banks are going to continue to lend. And I think other to companies in the U.S. that are going to want to open operations globally and hopefully in parts of Hong Kong.
All right. So another question to Paige is, I think Paige previously, she mentioned about and talked about the money market funds. So would you mind to share how the money market funds can help navigate those investment risk, market risk under the geopolitical tensions, as well as some macro factors in the market? Paige.
So if there was, additional stresses in the market, I can say that for money market funds in general, if you have your cash invested there, first of all, they're very diversified portfolios. We're only allowed to own up to 5% in any one issuer. We have high levels of liquidity to meet redemptions from shareholders. And we also have very short average maturities. So even though we might be buying securities with the maturity out 1 year, the overall average maturity of the portfolio itself is 60 days or less. So when there are points of stress in the market, we perform something called stress testing, and we do this on a regular basis. So remember, if you're investing in a money market fund, you put $1 in, you want $1 back. We're doing a minimal credit risk determination. So what we do is we look at the price of the portfolio each day, that $1, but we carry it out 4 decimal places, so 1.0000. And in a rising rate environment, your NAV, or that dollar price, might not be 1 with 4 zeros. It might be 0.9998 because the price of your securities is changing. So we take that current NAV and we stress it for various different events. I mentioned earlier that we think the Fed might raise rates by an additional 25 basis points. But what if we're wrong? What if inflation, the Fed is really concerned with inflation and at the next meeting they raise rates by 100 basis points? I don't expect that, but that's the kind of stress we perform on the markets. So we stress the NAV for interest rate movements. We then stress the NAVs for credit events. If there was another event in the banking system and we were wrong and it wasn't idiosyncratic and it spread across the entire banking system, not just in the US, but globally, we look at the percentage that we own in banking paper and we say, what if the price of all those securities widened out by 50 basis points? We then look at the positions that we own in floating rate instruments and we widen those prices by 50 basis points. And then we look at redemption events and we say, what if 10% of the shareholders redeemed all in one day, or 20 or 30 or 40? And then we combine those events for a stress and say, what if all of these events happen simultaneously? What would happen to that NAV, that price? And for a money market fund to have a problem, that NAV would have to fall below 0.995, because that would be, quote, breaking the dollar. But in the current environment, we're comfortable under all of our stress scenarios that those NAVs are appropriate to maintain $1. But that's, kind of a long-winded answer to how we stress portfolios for.
Yeah,
any
thank you,
client.
Paige. Yeah. From time to time, I think redemption is always a key factor that the investment manager have to take into considerations. All right. I do think, Paige, you also mentioned about one very interesting point. It's about ESG, which is always a hot topic. And in fact, we have another, panelist here, which is an ESG expert, and she's a CFO too. So Shiganda, all right. Would you mind to comment how ESG is impacting money market instruments? I do think as a CFO, you have a portfolio and you have been invested in different instruments, money instruments. Tell me more about how ESG is impacting your decisions or how it can impact on the money market instruments. So, Sugandhar?
Yeah. So Albert, I heard Paige and, investment managers and portfolio managers like her are, very, very in-depthly doing analysis around it. But when it comes to corporate treasurer like us, somewhere when you talk about ESG in money market, the response that we get is, isn't it something for a long-term investment? I mean, I should be worried if I'm investing in a paper which is 2-3 years kind of a paper, because ESG is basically the strategy of corporate in working more towards a sustainable kind of a goal. But there are two underlying aspects that they're missing. That in money market instrument, while the market instrument might be an overnight instrument, a 60 days kind of instrument, what we tend to do, is that as a corporate treasury, there are selected issuers whose paper we keep on rolling. So essentially what we're doing is, since we are rolling it continuously on a long-term basis, we're changing the timing of those papers, the nature, from a short-term money market to a long-term kind of exposure. And the second underlying fact is the issuer or the collateral which you're talking about is exposed to an ESG risk. Now, I might say that I have brought a commercial paper of a very well-reputed chemical firm with very good numbers which are coming. But if I am not aware of the practices on their environment side, and tomorrow there is a notice that says that they were doing a way of logging the norms of pollution, and all of a sudden the Pollution Control Board comes and says that the plant is closed. Am I not exposed to that kind of exposure even in a 60 days period? So ESG is becoming very, very critical even in money market instruments. The second important aspect is that sometimes when you talk to corporate treasurers, they say that, okay, so should we start looking at the ESG ratings of these companies? So my answer there is also no, because ESG rating, is an indicator of that particular company, in isolation, how their practices are. But let's take about two industries which are having a same ESG rating. Let's take a chemical firm or maybe an oil firm, and the other is a IT firm. These two firms might be having a similar ESG rating, but are they exposed to similar kind of risk when it comes to the ESG event? So the answer is no. The oil sector will be much more prone to the ESG risk than to a IT firm, because they are dealing every day with pollution and environment and other aspects. And therefore, when I'm choosing a money market paper, the ESG element becomes much more important when I'm evaluating a more riskier kind of a company. So ESG slowly and gradually is peeping in, and we definitely have people who are advising us. But as a corporate treasurer, we also need to start building that in our own portfolio and actively looking at it. Yeah.
Thank you, Sugandhar. Well, another question is quite related to fintech areas too. I think we hear about of the fintech collaboration in the digital universe by the speakers like Rakhi, as well as you, your sessions. So with this disruption, there is an expectation that the corporate treasuries will adopt technology transformation. So how should corporate treasurers go about the digital journey? So King, but you are like the spokesman from Hong Kong about these areas. You might share your real points. Try to tell us how well Hong Kong government has been helping promoting the virtual assets.
Well, naturally, we often try to distinguish our stance that we are not promoting or encouraging people to speculate on cryptocurrencies. So there's a very clear distinction between cryptocurrencies and digital assets. So we are more the latter. We're promoting digital assets as a form for us to transition into a digital economy. Now, so for that, again, last year, for those of you who follow the news, the Hong Kong government, led by our Financial Secretary, Mr. Paul Chan, he had made this really important policy announcement that basically said that Hong Kong welcome digital assets that includes cryptocurrencies. Now, of course, I think for a lot of the, particularly the external media, they often would equate, okay, China banned cryptocurrencies, so therefore Hong Kong must not be very friendly with cryptocurrencies. Now, but then that announcement pretty much just shattered this myth, if you will. Now, of course, I think we just don't want to just talk the talk. We'd like to walk the walk. So from the policy announcement onwards, I just, in terms of time, I just want to cite a few examples for us to walk the walk. Now, first of all, back then, I think November, I think the end of November, around that time frame, there's this Chinese asset manager called CSOP. So this is like the smaller version of BlackRock. It's the largest in China. So they issued 2 ETFs. And guess what? They issue a Bitcoin futures ETF and also an Ethereum futures ETF. Now, issue ETF is not anything new. But first of all, those 2 ETFs are first in Asia. However, just think about the background of this asset manager. It's a Chinese firm. It's a mainland Chinese asset manager, where the Hong Kong entity now is the first one. They issue like Bitcoin Ethereum futures ETFs to promote more adoption of digital assets. So that's a big deal, particularly for those in the digital asset space. So this is one. Now, and secondly, I think just now, Suganda talked about, I think from the corporate treasury perspective, and also trying to play the good corporate citizen role by embracing, perhaps buying some green bonds. So of course, in Hong Kong, we're also promoting green bonds issuance. In fact, I think for the past 2 years, Hong Kong has been leading Asia as in terms of issuing the most green bonds. If my memory serves me properly, I think the last, let's say 2021, the Hong Kong issued roughly 60 billion of US dollar of green bonds. Last year is roughly 80 to 90 billion. Okay. Now, but the interesting thing is, in mid-February this year, also in unison of promoting digital assets, we'd like to put the two together, the green and also digital assets, by launching the first ever on the planet by governments of tokenized green bonds. Now, the issue amount is not a lot. It's only 100 million US. And the distributors were the Goldman, the HSBC, Credit Agricole, and also Bank of China. But also, this is, I mean, it's not about the amounts, it's about the signal that we are sending. So number one, we are tokenizing green bonds so that more corporates, including the treasurers, can participate. The yield is pretty good, 1 year, 4.05%. Okay. At the same time, it's really about promoting like a new way of issuing green bonds. And that has some deep implication. So particularly, again, I'm by no means expert like Suhanda in the ESG space, but then, I mean, many of us have heard of greenwashing. But how do you track that the green bonds are really used in areas where they are really deploying to do green work? So now with the tokenized green bonds, you can actually bake in some of the data and the tracking in form of smart contracts and algorithms and so on, so that you can link the two together, the ESG reporting and also tracking maybe in the future, we got like richer, more complete Scope 3 data, and then you can tie back to the tokenized green bonds. So the application is endless by putting these two together. So this is just one example about how we are envisioning how the future will play out in fintech with the promotion of digital assets.
Yeah, thank you, King. I think it's music in my ears trying to plug in innovative technology like the blockchain technologies into ESG. Well, I call from time to time for some of my initiatives, I always married the blockchain together with ESG initiatives, and green bonds, tokenomics is a great thing, I think, to many people as well as the practitioners in the market, in the fintech market. Now, Rakhi, now would you want to share some of the cases how Indian government or regulators has helped to boost the fintech ecosystem in India? Because King already shared his group from Hong Kong, why not also share yours from India perspective? Rakhi?
Yes, sure. So I think in the last few years, we have seen some very tangible steps which are taken by the Indian government. One of that I also talked about uh, during my presentation. This was in 2016 when Indian government decided to go for demonetization and stopped the use of the existing currency notes. This really gave the much needed push for the digitization of the whole financial ecosystem, especially in the area of payments. That's where we saw a lot of fintech uh, use take advantage of that opportunity and come up with a lot of good digital solutions for the payments. Second is Indian government is also investing quite a lot to boost up the startup ecosystem in India. I think in India is probably is ranked third when it comes to the startup ecosystem in the world, and has more than 100 unicorns in India in 2022. So the Ministry of Education has come up with an innovation cell, which helps especially young college students if they want to become an entrepreneur. They really provide the right kind of guidance that is needed for any startup to find the right kind of mentoring, right kind of guidance to get started. So that's another thing. Third is, if we talk about regulatory changes, I think government is really looking into the current regulations, which can be a showstopper for the fintechs. For example, if I talk about what government did about 2 or 3 years back during pandemic, was to look at our KYC requirements, and they enabled video KYC so that the old form of doing that physical verification is not required anymore, and that really gave a boost again to the fintechs in India in getting more client base. So these are some of the things which Indian government has done in the past, and we see that even in the public domain, the way technology is being used is like never before. We are seeing reforms in a lot of areas in the public domain also in India.
Thank you, Rakhi. And I think during what you're saying is, I think I see a complete ESG too, because besides talking about environmental things, you're talking about how your government has been supporting on the youth entrepreneurs, which is a very important part for us, for the society. At the same time, you mentioned about AML, KYC, unlike Hong Kong governments, it's very important elements to governance. So I see a good combination of ESG, because from time to time, well, it's like what King mentioned, we see greenwash, and S and G are always the missing part. That both Hong Kong governments and Indian governments, that you are working very hard on this part too. And of course, US too, because I think for ESG initiatives, when we bring up long projects of ESG to Hong Kong and the region, as is, the starting part rather than G. I'm so happy that all of the speakers over here, as well as the petitioners, are working towards that direction. All right. Now, talking about fintech, all right, as well as technology things. I think I have to come to another questions where, Suganda, you are also expertise in this area too. Well, you might share your viewpoint from corporate treasurer's perspective, because I think both Rakhi as well as King, they talk about that from the government or from the country's perspective. So what's your viewpoint from the corporate as a corporate treasurers? What's your viewpoint?
So Albert, King and Rakhi had mentioned that government is, fast changing. In some places we realize that the IT enablement in government is so much fast that corporates struggle to provide them with the kind of data or responses which they expect from us. The banking system is also changing, the kind of payment method which is happening, the investment landscape is also changing. At the center of all those changes is the corporate who has to, really interact. Now, while everybody talks about bigger cultural aspects and digital journey, what really is missing with the corporate treasurer is that most of the corporate treasury do not have any kind of IT vision. They feel the pressure that okay, government wants us to do something, they jump and start doing a digitalization in isolation. So one of the key things which a corporate treasury has to do is they need to be clear about their IT journey. So when I talk about IT journey, they need to know that these are the various aspects that I want to digitalize going forward. Because but the fund availability and the bandwidth of manpower may not permit me to IT enablement, do the IT enablement now, but I have to do it in the future. If I land and jump, on some fintech which comes up or some solution which is given and IT enable it without thinking of what are the pieces this system will talk about, then sometime later I'll think about okay, now I have to find a fintech who can ensure that the two systems are talking to each other, which becomes a mess kind of a thing. So one is the IT vision and clarity on how you plan to do your IT enablement. The second part which the corporate miss is the architecture. Unlike a bank and other bigger institute, they are not focused so much on their own architecture. Now going forward, data is going to be the next oil. If you are able to capture the data at the right point of time and your architecture across the company is in such a way that the data entry is happening at one point of time, your 50% problem of IT enablement is solved. You're capturing the information right at the first point of time and there's no duplication. Once you have all the data, analytics, and ability to build any kind of system or software or integration on top of that becomes very, very critical. And the last piece from my side is that we are bombarded with so many fintechs coming us and telling us that do business with us, we are the best. Now, how does a corporate, judge? How that becomes a rather critical problem. So the corporate should be able to take this call as to what is the right fintech. Do they have the right data confidentiality policy? Do they have the right privacy policy? Do they have the right kind of integration and security setting? So somewhere, corporate treasury takes a decision, they miss that these are the critical aspects. So these are three key points that a corporate treasury, in my mind, should keep in mind when talking or onboarding on a digitalization journey.
Thank you, Sugandhar. I think in these questions, we talk about the marriage between technology as well as ESG. Okay, let's come back a little bit. Now, the quick questions we would like to, what will be the marriage between technology with assets management on the fund side, right? So, King, so what challenges do cross-border payments encounter and how could fintech help? I think right before in your previous speech and presentation, you talked about stable coins. Can you share more of your insight going into a more deeper dive?
Well, it's always about the whales, right? So we will talk about the antiquated whales that we have today. And of course, I think the notion of people are so afraid of SWIFT. Of course, I won't go into details, but then there's also the back of the mind of some corporations. So that's why, for particularly, as I mentioned briefly in my presentation early on, why I mentioned those LATAM countries is because, again, it's not my words. I was just repeating what I heard right from all these conversations, that they would like to have some alternative rails in which they can rely on. And of course, along the way, for those rails to be more efficient, i.e. lower fee, that's great. And so now that blockchain has been really gaining a lot of traction internationally, and in fact, there are some private sector players already using, for example, USDC, the stable coins, to facilitate cross-border payments. Now, one of them, interestingly, is a mainland Chinese firm. And they already have contracts with over 30 countries around the world, but mostly are emerging markets. And right now, they are facilitating all these cross-border payments using USDC on the blockchain rail, as opposed to traditional rail. And I think as more and more markets, including Hong Kong, are giving out the right kind of regulation to essentially manage and regulate, the license operator or the license issuer of stablecoins, the right reserves and so forth, then I think that would perhaps would really promote even more adoption. And by then, I think the next question becomes, so, okay, with the stable coins gaining traction, the USDC, and maybe the Hong Kong dollar and whatnot, then the question becomes, where does CBDC stand with respect to stable coins? Because on the surface of it, they're kind of the same thing, right? Digital money. But in a way, they're not exactly the same because there's always the counterparty risk. For stable coins, like a licensed player, powerful, well-regulated, things can still go wrong. But CBDC arguably is issued and backed by the sovereignty. So you can argue there's no counterparty risk with CBDC. So I can imagine in the next, say, 2 or 3 years, there'll be a next wave of discussion about the positioning of CBDC against stablecoins as a form of cross-border payment.
Thank you for King for sharing your insights about CBDC and talk about CBDC. I think that helps to increase the money velocity and increase the economic activities in different locations too, as well as to facilitate the money transfer things or cross-border transactions among countries. Well, because CBDC is quite related to wholesale CBDC, which I mean the RMB, as well as retail CBDC of the Hong Kong dollars. All right. I just mentioned about cross-border payment transactions, asset allocation, which is always a challenge to the fund managers. So, Paige, well, would you mind to share some of the thoughts or examples regarding how fintech can help on your business as well as on your fund management things?
Well, honestly, I don't think we have, our salespeople are in the audience here too, but I don't think we have any activity that's on fintech right now. I mean, I know there's talk about trading money market funds or trading other mutual funds on the blockchain, but that hasn't really happened yet. But as far as, being able to trade a money market fund as an investor, you can trade via portals, but I don't think you consider that to be a fintech option. So I think we're a ways away on the mutual fund side.
Thank you, Paige. Different stakeholders are playing different parts of roles in the money market. Okay, Paige, I think you can work closely with King because King may introduce some of the solution applications to you. And after all, I think different countries are working on CBDC. We will find out the right way, try to smooth out all these money activities across the market in different regions. All right. So, Rakhi, I have to come back to you because you have the expertise in these areas. Well, tell me how and try to share how the emerging technologies are impacting new age of fintechs over the cross-border payment solutions.
Yeah, sure, but I think a lot of it is already touched by King. But I think 3 of the things which I can think of right now is one is definitely blockchain, the distributed ledger, which King also talked about. I think the way it is changing cross-border payments is that it's making it much more faster and it's making it much more cost efficient. And if last year, 2022, was all about payments, at least here in India, account-to-account payments, I do expect that a lot more action will happen around cross-border payments in 2023 or maybe next year. Second thing which I can think of is the UPI technology, which India has been using, Unified Payment Interface. And if India is thinking of partnership with other countries, how can that impact the cross-border payments and how that technology can be used to make it much more faster? And third is, again, King has already touched on it, but India is also coming up with its own digital currency, e-rupee. So central bank's digital currency, which we have been talking about. So the kind of collaboration or the integration that we can see around CBDC can have an impact on the cross-border payments. And it would be really interesting to see how fintechs can use these new things which are coming up, new technologies which are coming up, and really make cross-border payments much more efficient than it is right now.
Thank you, Ray. I think that you share both the same, the same view like Kings. And to be honest, I think for CBDC things, it's not only increase the money velocity, as I mentioned, but at the same time, because we'll be using the blockchain technology. That means we are enhancing the data quality, which means provide better positions and better quality of data to the governments at the time when they form the monetary policies, particularly over some of the regulatory risks like AML, KYC, because for the blockchain technology, when a customer on board, well, they have to provide more, more accurate data, more detailed, so as to facilitate the retail CBDC in the market. All right, so thanks very much. So I think I will finish all the questions, planned questions that's set by our speakers as well as by myself. So perhaps next sections, we can start early with our Q&A sections. I received questions. May I ask, is there any questions on the floor? I see a lot of an audience over here, came from different sizable organizations. So yes, please, gentlemen on the second row.
Hello, David Clark from Avenue Shangri in Hong Kong. We're one of those small new businesses from the UK that's just moved over and started an operation. And thank you for all the help from Invest Hong Kong and your team. And thank you for the invitation today as well. A sort of general question, I suppose. We've obviously had some super help here from Invest Hong Kong and financial services, the traditional banking side. I was just curious, perhaps, to Ms. WILHELM, when you talked about, well, two things really. One was around sort of the US situation and your stress testing. I suppose first thought is, what are your thoughts on, we've heard a lot of news about the debt ceiling and President Biden's comments. It was quite scary yesterday.
Yes.
A general thing, what's your thoughts on that? Is this going to be like in the past 64 occasions that it'll be talked about and then somebody will blink? And that was the first point. And then a second one was around, you mentioned about SVB, the US Silicon Valley Bank. Obviously in the UK, we had a quick sale to HSBC. But in the US, I'm mindful American Banker, reported 18 months ago that SVB California had a major shift into securities during the pandemic, a lot of it commercial mortgage-backed securities. And the question, was the regulator, did they have their eyes shut? Are we missing some kind of alerts and technology? So those 2 points, please. And sorry to drop them on you.
No, that's fine. I'll start with SVB just because that was the last question. You're right. SVB saw extreme growth after COVID and, during the next couple of years, they saw huge deposits come into their bank and a very concentrated base of shareholders. As you can imagine, it's the technology area and a little bit of healthcare, but they were large institutional deposits. So I think their deposit base was about 80% large institutional, meaning those deposits that were not insured by our FDIC, which, by the way, that's greater than $250,000, not millions. So as that money came in very, very quickly, the bank was forced to invest in securities to offset that. And surprisingly, they actually had a lot of Treasury and agency securities too. I think their portfolio, their balance sheet of portfolio securities available for sale was about $28 billion. So now you get on, no offense, social media, and the tech industry says, oh my gosh, look at this bank, you should take your money out. And they all social media feed off of each other, just like teenagers do, and they start taking their money out. So Silicon Valley Bank is forced to sell those Treasury and agency securities, which you think are, highly rated, at low prices because they bought them when the interest rate environment was 0 to 1%. And now with interest rates at 4 or 5%, they were forced to sell those securities at losses. They couldn't meet redemptions. The FDIC came in and took over. So that's, that was their whole asset liability mismatch, really. They had 80% of their deposits were uninsured deposits, was those institutional investors. That's why you saw the US Treasury, the Fed, FDIC step in to help them out. That's not the same asset liability structure as we see in the majority of the banks in the United States. Most of them have retail deposits or those insured deposits that are 50 to 60% of their balance sheet. So not, the 20%, 80% that we saw at Silicon Valley. That answer your Silicon Valley Bank question?
Wonderful. So what was the SEC that they missed?
Oh, the feds. So actually the Federal Reserve is who's in charge of, oversight of the banks. And apparently they were in there, looking at them. But one of the Fed governors is actually in charge of that whole investigation and is supposed to be releasing his findings very soon. Chair Powell mentioned that at his press conference a week or two ago. And, our bank analyst is fairly certain that you will see changes from a regulatory standpoint to those mid-sized banks, those 100 billion to 250 billion in size banks. So, who knows how long that will take, but we will see some changes there. And then with regards to the debt ceiling, well, like you said, this is the 64th time that happened. It will probably play out like it does every other time. Yesterday, when the president met with Congress, nothing will happen. They'll just look at each other and they'll wait till the very last minute, which, right now is sometime around June 1st is supposedly the day that will, have a problem. That will be the X date. And I'm sure it'll be that night at midnight or later that they'll come to a resolution. But I think that Biden, as well as Congress, knows that you cannot default on US debt. So it shouldn't. And by the way, if there is a technical default and you're invested in a government money market fund that potentially owns a Treasury security that matures on that X date, that would not cause a problem with that money market fund. There's no cross default. It would just be that one particular security that would default. There's no cross default to other Treasury securities or agency securities that you might own. And the SEC, we have to follow a rule called 2A7 if we manage money market funds. That technical default does not mean you would have a problem with your money market fund. They would still allow you to value that security, at something, knowing you're getting your money back in a day or two. It hasn't, it wouldn't go to zero like a Lehman Brothers.
The US dollar down. Great.
Yes, exactly.
Thank you.
The second question seems to be the key question.
Yes, it is the key question.
Yeah,
it's the most annoying thing that's out there. Sorry.
Yeah. Thank you, Paige, as well as the questions from the floor. I think we can still answer one question that I received online, all right? And I think, well, Sugandha, you are the treasurers as well as a CFO in organization. I do think you can help to answer these questions. Now, traditionally, investment products with shorter maturity, higher liquidity, and lower transactions are more suitable for treasury management programs. So with digitalizations, make alternative access a more investable asset class for corporate treasurer. So,
Albert, you will have to repeat the question once again. I'm sorry, it was breaking.
No problem. Yeah. Traditionally, investment products with shorter maturity, higher liquidity, and lower transactions are more suitable for treasury management programs. With digitalizations, make alternative access a more investable asset class for corporate treasurer. So be short, if I will summarize these questions, but will digital access be an alternative investments for the corporate treasurers nowadays?
Yeah. So the first part, which was there where they're talking about short-term investment being the best option for the treasury, that is something which I disagree with. The investment policy of a corporate treasury should be driven by the needs of the business. For example, if I do not have an immediate availability, for example, as a corporate, if I'm a cash generating corporate and I do not have a visibility that I have capexes where I can invest this cash and I can deploy it further to expand my business, then I would like to prefer to run a longer term strategy or a mix of a long and a short term. Whereas compared to a corporate, who feels that the cash is available only for a shorter period of time, that's when I will be running the short term this thing. As for whether the digital investment will become an alternative, as of now, the governance or the policies of government around these digital investment is not clear. Till the time the taxation aspect and the stance of government becomes very clear, the ability of a corporate to incorporate this policy will remain low. For example, in India, the Bitcoin, the government was completely silent on the investment on the Bitcoin. All of a sudden, they came back and said that with retrospective effect, they have now changed the taxation policy, where on the Bitcoin, they will apply taxes similar to a lottery kind of a thing. That means whatever I've earned on the entire portion, I lose a significant part. So let's take an example of an investor who said that every year I will invest 10,000 rupees, then I make some money, and then after 1 month, I take it out and then I reinvest it again. So unless he's able to show that it was his original 10,000 which he has reinvested, 70 times, the government will assume that it is 10,000 into 70 is what he had invested, and similarly tax him on that. So till the time the taxation and the regulators are not clear, corporate treasuries will not be evaluating it, and it will be very risky to put such money in unregulated kind of. So policies won't allow it.
Yes, to the risk. And from time to time, when we do the investment, we have to take into consideration of our original investment strategy, as well as the risk appetite, which are qualitative factors more than the quantitative factors from time to time, right? So thank you very much to Sugandha. I think we are close to the end of the forum. So thank you to all the panelists over here in Hong Kong, okay, as well as joining us remotely from overseas.